Welcome to Flipping Out with your host, Paul Lizell, your leader in virtual wholesaling and investing in today's real estate market. Each week, he will be joined by some of the biggest players in the real estate space who will share their experiences, knowledge, insight, and tips for making it big in the industry. And now, here's your host, Paul Lizell.
Hello and welcome to another episode of Flipping Out. This is Paul Lizell, your host. And today I have with me Ruben, I hope I pronounced this right, Izgelov. Is it Izgelov? Is that correct?
Hit it on the head. Very well said.
Beautiful. And Ruben is an investor as well as he works with WeLend, which is a nationwide lender, right? And we're going to get into deep details about what he does there. But Ruben, before we get into your lending, tell the audience about what got you started in real estate investing, when you started, what the market was like, and what your focus was, and how you've shifted over the years.
Sure. So I started kind of the real estate journey really early on. I would say around 13 years old.
Oh, wow.
A cousin of mine who was door knocking in Queens, New York, some of the rough areas of Queens, New York, he had trouble getting some doors open, right? And he had this one genius idea one time. He said, you know what, Ruben, why don't you come with me door knocking? I was 13 years old. Why don't you come door knocking with me? You know, if they see a 13-year-old, George Clooney lookalike, they're probably going to open the door for you more than they will open for me. And he was right. I think the first the third door that I knocked on, the door was open. It was a lady who said, what's going on? And boom, my cousin swooped in and said, hey, look, I see you're in distress. I'm looking to buy your property and what have you. Believe it or not, that deal also turned into a flip for him, right? So I was able to see the birth of that deal from literally knocking on a door all the way to the closing table. He made sure that he brought me to the closing table, and he gave me a couple of $100. So for me, that was like, wow, this is the world of real estate. I made a couple of $100. All I had to do was knock on a door. So it was really kind of like a special time for me in life where it was like an aha moment. All right, real estate is the place to go. But I also had to go back to school, right? That was a summer kind of gig. I had to go back to school, and unfortunately, later down the road, I decided to drop out of high school. And I thought that was the best decision I could make. And rightfully so, it kind of led me into the place that I'm at today, because when I dropped out of high school, I went to the world of business, and I was working for a mortgage brokerage shop for many years, and then the great financial crisis hit, right? Yeah. So I went from making a ton of money down to basically barely paying, my rent. And my father kind of sat me down and said, look, son, things happen, right? People never work in, consistency. Things happen, ups and downs will happen. The question then becomes is if you have a family and you have a down moment, what are you going to do to hedge that? So he kind of walked me through the process of, hey, education is important. So I ended up getting my GED. I ended up going to St. John's University here in Queens, New York, and ultimately went to law school. This is from a kid that thought, education is not for me. I can do it without it. I ended up going to law school and graduating top of my class, magna cum laude, and the whole nine, right? Taking the bar exam. But while I was in St. John's, while I was, in law school, I was also flipping properties because, again, 13 years old, I got the taste of real estate. Making a couple of $100 was all I needed to do. So while I was in law school, we were buying, selling, flipping, developing real estate. And the way in which we got into private credit is that, a friend, now he's a friend, but at that time, he was running the Pitbull Conference. Now it's called the National Private Lenders Association, which I sit on the committee on. And he said, look, I see that you're a fix and flipper. You got to come to our conference because all the hard money lenders are here. You need to find a cheaper source of capital for the deals that you were doing. And he was right. At that time, I was paying 15% with like 4 points. And I went into this private lender conference thinking that I'm going to find a cheaper source of capital for the deals that we were flipping. I went in there as a private investor, private developer. I walked out as a private lender, and we've never looked back since. And since then, we've originated about $700 million across about 1,400 loans nationwide. And it's something that I got to tell you, I till this day cherish the call that came in that day while I was in law school, right before I started studying for the bar, because it brought me to the space of the private credit. And one of the biggest questions that I get asked all the time is, Ruben, why would you want to go into private credit versus private equity and buying, selling, flipping, developing real estate? And what attracted us to the space and kept us here is that we're able to hit equity-like returns while being in the safest part of the capital stack. Again, we're able to hit equity-like returns while being in the safest part of the capital stack, and it's true passive income. It's mail check money. Obviously, there comes, bumps down the road, but that's what really attracted us and kept us in this space. Long-winded answer got in there, so forgive me.
No, that's really great. That's a lot of great details and stuff. And I agree with you. The private credit is definitely, I think, the better side to be in there, to be on the lending side. And you know, got first position against these properties, which are good assets. So it's good paper. It's good paper to have for
Totally.
sure. And then behind most of these people that you're lending to, are probably a lot of them are experienced investors, right? Who have done multiple deals. You have good people behind it for sure.
Oh yeah. So, you know, the good part about what we do is that, you know, today a good 83% of our loans are actually with experienced operators, and a good 70% of our loans are actually with returning borrowers. So
Nice.
that makes us feel comfortable. You know, I don't want to say we shy away from novice or new investors, but, you know, if a novice investor comes in, we're not going to give them the same leverage points or the same terms as we would to an experienced operator. And that's not because, you know, we dislike novice investors. No, it's just there's a higher grade of risk with, you know, investors who are just starting out. You know, I remember my first flip, it didn't go as well as I thought it would, right? And that just comes with experience. You got to kind of develop the foundation for you to be able to really turn on the knobs and turn on the faucet to get you to the next level.
Yeah. And your company's no different than any other asset-based lender out there. Kiavi, Lima One Capital, Lending One, all of them will lend less to the inexperienced investor at first. Once you get a few deals going and you've got some experience, then they'll go higher in leverage. And that just makes sense, right? I mean, it's risk. It's underwriting, it's risk. It's just like somebody going to get their first house, right? They got to fit within the right debt to income ratios, all these different things. Good credit, right? The better your credit is. And credit essentially here is what you've done in the past, like how many houses you flipped, how many houses you manage and stuff. So
yeah, because as private lenders, as hard money lenders, although we try to stay away from that term today, you know, sitting on the advisory council of National Private Lenders Association, we don't want to be termed or viewed as hard money lenders because we're really institution. You know, the space has become institutionalized, right? There's been a lot of Wall Street money that's come into this, and you mentioned some names who have been backed by institutions. So we're trying to stay away from the term hard money. But yeah, you're right. Look, as private lenders, we're not looking at the borrowers or the sponsors for you to, we're not looking at their potential bank statements or tax returns. We're not looking at their personal ability to repay our loan. What we're looking at is, okay, what are you buying? What's the property worth today? What's the construction value? How much work are you putting into it? And what's the resale value? Because all of our borrowers today, they're buying these properties specifically to flip them, right? Some of them today with the evolution of the non-QM space with the DSCR products, the bank statements products, the P&L products, and so on, a lot of borrowers have been kind of converting over from a fix and flipper to a fix and holder, rightful so. But really what we're looking at is, can you really repay our loan within that 12-month term that we're giving you? And by doing so, when you are repaying our loan, are you making a profit? Because obviously no one wants to work for free. And what we've learned is that the borrowers who are actually losing money on a deal, especially the novice investors, are the ones that are defaulting. So like when we look at borrowers' deals, we look at it from a lens of, although we're their lender, as a partner, because we want to make sure that they're successful in their flip. We want to make sure that they're making money, because if they are, then the likelihood of them repaying our loan is even greater.
Yeah, it's a partnership in a way. I mean, you want these people to be successful. You don't want that property. That's not what you're out there to do. You're out there to lend and make a return on that and not take the property. I will tell you a funny story. The private or the hard money lenders, like that term that you're referring to, when I first started in 2001, to borrow from hard money lenders, and they would be like 4 or 5 points, 15%. And I got them down finally like 2 or 3 points and 12%. But there was one particular hard money lender that he would lend the money and try to end up making these people go bad to try to foreclose and take the property. He had bad reputation. He's out of the business now. It was unbelievable what this guy would do. He did other things as well. Like he would, there's an assignment deal going on. He would go directly to the seller and take that deal from him. This guy had a bad rep. He was just a scumbag. The rare one out there, right? But those guys don't last long. But the whole point is that the 4 or 5 points and 15% is not happening anymore. With institutional money out there, you're a point or two, or depending on your experience level, you could be a half a point and maybe 8 to 10%, depending on what rates are going at. It's a whole different there's a whole different playing field out there for people out there getting into the game that we didn't have when we initially started.
And I wish we did, but I guess everything comes with time. And then the question really comes down to, well, first of all, by the way, that guy that, is a lend to own kind of, or a lender, they exist, right? I think we all have to agree with that. And I think one of the main reasons why a lot of borrowers, when they tell me, hey, I work with one guy who is my lender and he's been my lender all the time. And, I call him on a personal level and what have you. That's great if they're not a lend-to-own type of lender. But even if they're not, if some guys who only work with one individual person, like I did when I was in the fix and flip space, the problem there becomes really is, well, are they going to be in a good mood when I call them for a loan? Are they available when I call them for a loan? From time to time when I was using my hard money lender, again, he's actually a dear friend of mine. He's a mentor to me. He's also invested into our fund. If he was on vacation, I wasn't buying any properties for those 2-3 weeks, right? And he would go on long vacations. If he was, for whatever reason, not feeling well, he was hospitalized or what have you, he was an older guy and, great guy, but older guy. If he was hospitalized, I couldn't get my construction financing, right? I did the work and I needed to get my draw. He wasn't available. I can't blame him, right? He's in the hospital. He's on vacation. So I think that a lot of groups, borrowers, they have to understand and recognize the fact that you want to work with a company. You might sometimes pay a premium for it, but you want to work with a company that exists regardless of whether they're on vacation, the CEO is on vacation, or if the CEO is just unavailable, because then you will have the consistency. And back to the other point is that, the cost of capital has dropped dramatically. And the main reason why is because Wall Street has been entering Main Street, right? And they've been pouring money into our space. The question then becomes, what do they see that others don't, right? And what they're seeing is that the real estate supply is aged. Well, we need fix and flippers to improve the real estate market, the stock, right? Because today, there's some data showing us having the supply deficit of about 6 million homes. Right. The Gen Z and the other groups, they're starting to buy homes. Yeah, they're a little late in the game, but we're starting to buy homes. And guess what? We don't have enough homes to buy. What's going to happen then? That means that the values of the properties are appreciating far quicker than we can afford them. So I think that, the space has matured where Wall Street is recognizing, and they're smart guys, they're recognizing the value, the consistency, and the security of the private lenders and the private loans that we originate. And that just is a token of who we are and what we're doing.
100%. And you guys are in the Northeast and you focus, a large part of your portfolio is probably in the Northeast, as we were talking earlier. And in that particular market, right, you don't have a whole lot of inventory, and that's where things are really constrained. And that's where it's really tough for your first-time home buyer to get in there. And Gen Z, right? Gen Z buyers that's my kids. My oldest is 22. He's just out of college and he's renting an apartment, of course, right now, but he doesn't know if he's going to be able to afford to buy anything up in the Northeast where he is here. So we'll see. There's other markets people can go to, obviously, in the Midwest and in the South. It's a little bit cheaper. Florida's on sale right now where I live. You can get good value, good pricing down there. Texas as well, but Northeast is definitely constrained, no doubt about it. And it's feeling it. Yeah, but that's
hopefully things will improve,
I agree. And we do need to build more. We are like 6 million units short, like you said. That is a problem and we're dealing with it, and affordable housing, right? So instead of all these bigger homes, we might go down to the 3-bedroom, 2-bathroom, 1,500 to 1,800 square foot house again, which makes it a little more affordable, a little bit cheaper to build. The builders don't love to build them because they can't make as much profit on them. But I think what'll end up happening is probably some government incentives will come in there and help give them like tax breaks, right? Where they, incentivize them to do it.
Exactly. And I think that, not only the, federal government, the big government, right, but the local governments have to understand that, the real estate operators and investors, yes, there's some people who are saying, they're greedy, they're making so much money, but they're also bringing a lot of value, right?
Yeah.
The local government politicians, they're all screaming and yelling that the values of the real estate and, all this went up and that went up and that everything is appreciated, it's unaffordable. Well, if there's, millions of houses that are not built because of all the red tape involved in actually having to build it, well, guess what? What do you have to do? You have to eliminate all the red tape, because as soon as that supply is coming to the market, well, then that will depreciate the values of the other homes. So if anything, that's going to help bring the values down versus having to continue building on the red tape, continue making things much harder for the developers and real estate operators and taxing them. By taxing, the real estate operators and investors, guess what we're doing? We're going to other states where they're not taxing us. Yeah. So then, states like New York are now really getting the brunt of it all, because the local politicians may not view it the same way as Florida would, as Texas would, who are now, all these money is pouring in to Florida and into Texas And the values of the real estate there long term will start depreciating because of all the money that's come in there and all the supply that's available.
I agree. And where a lot of jobs would be. On Texas, obviously one of the biggest job states out there. Tennessee's done well, as also in Florida, of course. Yeah, COVID really pushed a lot of people down here. It pushed me down to Florida. But it really did push a lot of people. And we still got baby boomers that are looking to retire and move down south, whether it's the Carolinas, Georgia, or Florida, right? So we still have that movement going on. And I think long-term, it's a good play. And it's still affordable in different markets there in Florida.
You know, I just wish I can convince my wife to move to Florida. I've been trying, but she's just not out with it. You know, the state is too sunny for her, I guess.
It is fun. I'll tell you, I never thought we were going to move to Florida, but end up being a place we end up going to. And it's beautiful. We really love it. We play a lot of pickleball. I mean, any time of year you can go outside and enjoy it, which is phenomenal. And we come up here June, July, and early August before our daughter starts school again. And unfortunately, they start early there, but it's been nice. You know, we get the best of both worlds. We can come up here for a little while, enjoy New Jersey, and then go back down to Florida and enjoy the rest of the year there. We don't have to. You know, the Jersey Shore winters are not very comfortable. It's for sure.
Well, for sure. I'll live Florida through your eyes and through your experiences. How about that?
Beautiful. Yeah, you could come visit in January when it gets really cold up there. So
Will do.
Let's talk about you guys also raise capital for lending, right? So that is something else that you guys are looking to do. And I know we have in our group, we have a couple private lenders, people like doing it, but at some point it becomes like a burnout when you're like that solopreneur lender. So maybe it's easier to lend that money to you guys and get a different return, right? The return might not be the same, but you don't have any of the headaches that you would deal with being an individual private lender. So you want to talk a little bit about that?
Yeah. So, you know, to your point, even my hard money lender, when I was in the fix and flip space, actually invested alongside us, right? So he invested into our fund as well for that same reason. He's still making loans on a daily basis. Yes, some consistent clients that are still in the fix and flip space. But yeah, you're right. I mean, we're always raising money. We do manage a 506c Reg D. It is a private placement. It's a private debt fund. We're raising money from accredited investors. And thankfully today we're at a point where we've raised, you know, a good sum of money from friends and family and from others as well, even from some of our borrowers. Believe it or not, our borrowers have invested alongside us. The question is, why would they do that when they're in the fix and flip space? Well, a number of reasons. One, they trust our underwriting because we've underwrote them. They see how tedious we are from time to time, right? We cross every T, we dot every I. But also too, you know, some fix and flippers, they might be on the exit side of a deal. They just flipped the property. They can't really find another deal to invest into. And they just have that kind of weird transitional period of where they need to put the money somewhere else versus just collecting 4% on their CD, right? And today, our investors, depending on the investment amount, depending on the class of shares that they're hitting, are essentially hitting a return of anywhere between 13 to about 16.5, 17% a year. That's what we're projected to do for about 2025. And, you know, it's huge. And it's with monthly distributions to cash flowing within about 45 to 50 days of their investment, which is tremendous. You know, when you're investing into real estate, you don't really see any profits for a good year, if not 3 to 5 years, right? Depending on how big the deal is and what the plan is, right? Especially if you're in a syndication, you're locked up for 3 to 5 years with no cash flow. In a private debt fund, whether it's ours or someone else's, you will see cash flow almost instantaneously because we already have a book of borrowers that are paying us at a monthly basis. As the borrowers are paying us, we pay you.
And so your specialty is not necessarily bridge financing. You guys do that though, correct?
We do. So we also provide financing for essentially kind of like bridge financing for warehouses, for constructions, right? For bridge to stabilization, right? For a number of different assets. It's not just a 1 to 4 unit. It could be a multifamily. It could be a mixed use project. A number of different projects that we provide just bridge capital for. So it doesn't always have to be construction financing. It could just be that the borrower needs some bridge, right? You know, I had a scenario right now where the borrower had started building an office space, right? An office building in Williamsburg, Brooklyn. He had the acquisition financing. He had an institutional lender give him the financing for the acquisition. And now he already demolished the building. He is now at the point where he's pouring in the foundation and he's now looking for a construction loan. And I'm looking at that deal and I'm probably going to give him about 65% financing of the as-is value in the LTC just to be able to give him that construction financing that he needs to finish the project.
And that's actually, you're hitting a space that not a lot of the other institutional lenders out there do. doing some of the commercial stuff like that. And warehouse is highly sought after space right now, right? That's
Oh
probably
yeah, I mean, you want to see
space, right?
exactly.
And then also the multi-units. So there's a lot of these lenders who do 1 to 4 units, 1 to 5, and they don't want to do the bigger units. Do you guys have any limits on the multi-unit buildings as far as how many units that you lend up to?
So I look at things two ways, right? Either one, it fits the WeLend fund, right? So in the event that, and the WeLend fund is basically doing anything between 1 to 10, 1 to 20 units, right? Mixed use properties, but with the mixed use properties, we need to see, more residential space than we have commercial space. However, we're seeing a lot of deals that don't fit that box, right? The WeLend fund box. So what I started doing recently is taking on deals that don't fit the WeLend box and financing them through a syndication kind of process, right? So what I'll do is I'll bring in a couple of my friends and family. I might even bring in another institution to kind of give us some leverage on it. And then we do the loan through a JV kind of silo structure versus having to do it through our fund. A lot of our investors like that because they want to be able to kind of co-underwrite alongside me. They want to know exactly where the money is going, and they want to see the money is being recorded against that specific property. Versus in a fund, when they're investing into our fund, their money is going into a number of different loans. It's really diversified, a number of different loans, a number of different borrowers, a number of different asset classes. And some borrowers want diversification. They don't want their money into one single deal. And some borrowers want a little bit of both, right? Some investors rather, not borrowers. Some investors want a little bit of both. So, by being able to have one, the WeLend fund, and also the syndication process where we're putting money together on a specific deal and we're co-underwriting it alongside each other, really gives the investors that we have in our fund and our friends and family the takeouts and the ability to invest in their hard-earned money into deals that make true sense. And most importantly, Paul, I gotta say, they're truly passive cash flows, right? Because as a real estate operator, you know this better than anyone. It's never really passive. A lot of investors are investing into real estate thinking that it's passive. It is not passive, right? And I think a lot of investors need to realize that, especially the doctor or the attorney or the architect who wants to start investing into real estate. They have a full-time job. They're buying a 2-family house, and all of a sudden, the tenants stop paying. Well, guess what? Now you have to work on that, right? Or the toilet broke down. Guess what? You have to work on that. You got to work with your property manager. You got to work on the financing. You got to work on the refinancing, and so on and so on and so on. So it's really not passive. Whereas being a lender, it's true passive income.
Yeah, it really is. It's without the headaches of tenants and toilets, as you said. When you do that. Private lending is, to me, the best side to be involved in real estate business, just because you don't have to deal with any of those headaches like that. Like I said, if something goes wrong, you have that asset too, right? To be able to
exactly. And the other challenge is that, being a lender, you don't really have the real tax benefits as you would being an operator, right? You don't have depreciation, right? You don't have appreciation, right? You don't have any of that. But what you do have is consistent cash flow, right? A lot of our investors today in our fund and our syndication process and vehicle, they're not looking to become rich. They're looking to stay rich, right? They're just looking to maintain their wealth and be able to receive cash flow. And that's what attracts them into being lent. And look, some of our investors today, they're high net worth, ultra high net worth guys. They do have a full-time job. So they are diversified. They not only invest into private credit with us, into syndications with us, but they also invest into real estate passively through other groups. So, people like yourself who are bringing them these opportunities, they invest alongside them. The challenge there is if something goes wrong, the lender in that deal is a lot and far more secured than the equities, limited partner investors. Why? Because the limited partner's money and capital and equity is subordinate to that of the lender, right? So if there's any kind of market shifts or headwinds, the first one to lose are the LPs in the equity deal. Versus in being a lender, you have a lot more subordinate capital that is lost first before anything else. But again, back to that point, playing devil's advocate here, you don't have all the value from, the tax benefits, all the appreciation, and really the longevity of building growth and generational wealth for your children.
No, 100%. And that's where I've gotten, I've had rental portfolios, sold them, got more, sold them again. And now I'm in the process of rebuilding my rental portfolio. And I'm hitting different markets, right? I'm focusing on Florida. I'll probably do a little bit in Tennessee, Texas, and I've done some in Wyoming as well, even Casper, Wyoming, small little town there. And then outside of Gillette, Wyoming, taxes are super low there as far as real estate taxes. So that's been one nice advantage. And there's It seems to be pretty steady jobs in those markets for the most part. What are your terms right now that you're running on the refinance, like a cash out refinance? What's your typical term look like right now and rate ballpark?
On a DSCR product?
Yes. Yep.
So we'll go up to about 75, 80% of LTV. And we'll be at about, I would say, as low as 75 DSCR ratios.
Okay.
Right. And it will rates, I believe, are landing anywhere between like that high sixes, mid sevens range. Obviously, rates are always kind of fluctuating, and it's really hard to kind of keep track of, especially with, our current, government that hopefully stay consistent and they'll stay consistent.
Yeah, we're trying to figure out where long-term rates are going. And at one point last year, that a lot of the people are predicting the rates were going to drop a bit. Now I think we're at the point where like we just don't know what the rates are going to be like.
Just know what to blow, rock with the punches.
Yeah, I'm hoping that long-term they'll go down, and I'm kind of playing with a couple of them that I end up refinancing here with doing the 5-year fixed and maybe looking or 5-year interest only, and then hoping the rates are a little bit lower. It's kind of a gamble though. You just don't know what they're going to be. I mean, historically, we're still below the national average of 8% that we've been in the history of this country. We're still below that. So when you look at that, rates are still pretty solid. Just we got spoiled with those 2s and 3s and 4s over the years, and it hurts cash flow.
Believe it or not, all that's been about 5 years ago. So it's crazy the time flies, but yet it's so near and dear to us.
Yes, no, it is. But I don't think we're going to see those rates again. We have a lot of headwinds against that with, the dollar losing value against other currencies and stuff like that going on. So, but we will see. Hopefully we can get into the 5s. It's amazing. If you lose a half a point in the rate, you bring in something like 6 million new potential borrowers. It's a pretty high amount for each year. Yeah, it's so. I mean, that's where the whole affordability issues are coming in, and that's why you went from 28 being the average age of people buying to 38 in the last decade. That's changed 10 years. It's unbelievable. Yeah,
and I guess that's why our president is fighting so hard, tooth and nail, right, to get JP to reduce those rates. So
yeah, we'll see what Powell does. I mean, he was trying to pressure him yesterday, if you saw.
Oh yeah. I mean, I know we're recording this, but we're in July, end of July. Yeah, it was interesting how that worked out. I was glued to the TV watching kind of them interact with each other. It was interesting.
Me too. They hate each other.
Oh God. Oh goodness. I think JP took it well. I think he did what he can, but Donald Trump will be Donald Trump. That's
exactly right. The one thing we love about him is he's a real estate investor like us.
Exactly. He's looking at the bottom line. That's all he cares about.
That's the truth. That's the truth. He is. And, if once Powell's out of there, whether Powell reduces rates, he'll put in somebody like Scott Bessent, who will probably reduce the rates. And that could in turn help the 10-year treasury. We don't know if it will or not, which could reduce rates. That's the ultimate hope. We'll see what goes on there. I don't know whether you have a crystal ball that you can look into. What do you think rates are going to be like over the next year or so? Do you think they're going to be kind of steady?
I, as a lender, assume that they're going to stay high, right? I have to, because if I assume they're going to go down and I'm wrong, and it's possible that I am, well, guess what? Now I'm losing a lot of money, right? Yeah. And I'm losing friends and family money. That's just not something that I do. I'm a very conservative guy. Going to law school kind of teaches you to see the downside before you see the upside. I'm in no rush to gain business. Thank God we have enough loans coming in on a day in, day out, a month in, month out basis. But, I would much rather play it safe than be sorry. And I'm not trying to be in the corner licking my wounds. So we're keeping our rates consistent. We're not trying to race to the bottom like other lenders do, because guess what? Those are the first lenders to go out of business. There's a number of them that actually went out of business during the kind of the COVID cycle, right? Because they thought that the rates are going to stay as low as they were. And guess what? When they skyrocketed, they were the first ones to lose.
Yeah. Oh, we've seen that firsthand, and they all changed their whole lending protocols too. A lot of different companies out there, which was smart. You had to go with flow and had to adjust quickly. You got to justify. We were in unprecedented times, right? So you got to adjust with it.
You have to learn not only from your own mistakes, but from other people's mistakes as well. And you kind of got to see what history kind of taught us and served us.
Yeah. 100%. I do have another question here for you regarding co-living. Are you familiar with co-living or Pad Split, a company called Pad Split?
I'm not familiar with Pad Split, but I am familiar with co-living. Yeah, a friend of mine actually in Chicago is very active in the co-living space. He's been making a ton of money doing that, though. Very familiar with it.
I'm doing that right now. So I have a property in Florida that was a 4-bedroom, 3-bathroom with a 2-car garage. I converted to an 8-bedroom, 4-bathroom. Got rid of the garage, obviously, and that's just going online to rent right now. And the rents are phenomenal. And the reason I ask you is because there's not a whole lot of lenders. There's only like 2 different lenders out there who are willing to do these co-living loans. And I think it's something as the affordability we talked about with real estate, as it continues to be difficult for people, that becomes a more and more popular thing to do. And HUD actually, Housing and Urban Development, actually pays for the rooms for the month. They don't do it weekly like a lot of the co-living does, but they will pay for Section 8, a room for the month, which is pretty interesting. So if the government is involved with it, it's something that's going to probably be around for a little while here and does help with. Is that something that you guys have and potentially look at down the road? Is at lending
on the term side, on the long-term side, I don't believe we would be. On the bridge side, happy to take a look at that.
Yeah, that's where it makes a lot. You can bridge it, and then it can always go to one of those other companies that does it. And what a lot of them do is they'll just look and say, "Fine, we'll lend this to you, but we're going to lend it to you based on single-family rents, right?"
Exactly.
Which is totally fine. And the properties I have would still cash flow with that. It just doesn't give you the extra ability to pull what that, instead of renting this thing out for $4,000, I'm going to be able to rent it out for $7,500 as a co-living. So it does boost everything, which is nice.
I mean, it's kind of like the same, you could say the same approach as Airbnb, right? A lot of lenders on the takeout side, they understand that you're Airbnb, they understand the community, the neighborhood is only for Airbnbs, and the rent is a lot greater through Airbnb. They recognize that. They understand that. Yeah. But they have to assume, again, we're lenders, right? We always have to assume the worst. In the event that you cannot get Airbnb or some laws change for Airbnb, again, kind of going back to all that red tape that the government's kind of implement. If the laws change for Airbnb and you can no longer Airbnb it, you have to rely on just kind of regular old tenants, right? Occupying your unit. So we have to think worst case scenario. And that's kind of the basis of what we do when we lend on through the WeLend side.
And that's smart. You want to be conservative with it and stay conservative. And if it ain't broke, don't fix it, right? If it's working, continue with it and just build upon it and just add more. That's all.
Totally.
And we're clients. So I may be reaching out to you for multiple things. One, for potential lending here, because I like to use multiple lenders here, and I'm buying all over the country, and it looks like you're in the most markets I'm in as well, which would be very helpful. But I want to talk to you maybe offline a little bit about the lending side there too, what your requirements are and things like that. So that's something I'll connect with you after that on this.
But
if anybody else wants to reach out and talk to Ruben again about lending opportunities and stuff, what's the best way for them to connect with you?
They can visit us on our website, www.welendllc.com. We're also on all major social media platforms. Our handle is WeLendLLC. And they could also always email me at ruben@welendllc.com.
Perfect. No, that's awesome. I will definitely be connecting with you on that. Lastly, what do you foresee the future? Just a question for you. I love to ask people like what they think is going to happen here in the future with the real estate market. A lot of people are obviously calling for a crash. I personally don't see the crash. We still don't have as much inventory as we normally have in a healthy market of 1.2 million. So we're still below that. What are your thoughts in real estate over the next 5 years? Kind of chop sideways, maybe creep up a little bit in different markets?
It's hard to tell. The one thing that I do follow and I'm always kind of obsessed over is the supply and demand, right? Yeah. That kind of governs everything, right? Today, if you look at kind of workforce housing, it's almost non-existent, right?
Right.
The rate that it's renting at, it's no longer workforce housing. And the reason why is because, again, supply and demand, is just not enough supply for it. So my whole viewpoint is if the supply stabilizes, right, then yeah, we might be talking about a potential crash. But if it doesn't, well, then the values of real estate are just going to continue going up, right? So, that's kind of the way I view things. All the other kind of, general viewpoints of tariffs, immigration, right? The Fed's cutting rates or not, those are things that are really uncontrollable by us, right? I mean, we do, regardless of what we say, it's still not going to govern what's to come. Things outside of our control, I can't really foresee, but I know that one thing, that I like to do is be a lender and not a landlord. And the reason why, again, is going back to that same point, is that in the event of any market shifts, we have to see at least about 30-40% price depreciation in real estate values for us as lenders to actually start losing principal. So, thinking of that and taking that approach, regardless of where our money was, whether it's with JP Morgan or not, if we saw 40% price depreciation in real estate values, wherever our money is, it's lost, right? Because even during the great financial crisis, I think we only saw about 28% price depreciation, according to the New York Times article that I read a couple of weeks ago. So, you're not really able, as a lender, being a lender and not a landlord, you're in the most safest part of the capital stack. You have a lot of subordinate capital ahead of you. And I think that if you're a person who is conservative like I am, or who always sees the downside before they see the upside, being a lender, not a landlord, is a lot more favorable.
Yeah, no, I completely agree. Completely agree with where we're heading and what's going on. Yeah, I mean, it's just, you think about that big crash in 2008 was created by all those crazy mortgages they made. You didn't have to have a job, you didn't have to have any income, and you were getting a house, right? That could only go bad. We don't have that now. So we don't have those things.
2 things, a photo ID, 3 things, a photo ID, a social security number, and a heart. That's it. Very good. That's it. Sign right here. You're good to go. Get out of here.
Yeah, I think the only big risk we have in real estate market moving forward would be AI just eating up so many good paying jobs, right? And that will be eating up jobs. There's no doubt about it. It's going to have that effect. But with anytime you have new technology come aboard, there's also more opportunities too, right? More entrepreneurial opportunities, more job opportunities that people just aren't seeing, right? People talked about the old money access centers, the old Mac machines, the ATMs. And they thought it was going to take all these jobs away. Well, somebody's got to make that machine. Somebody's got to maintain it. Somebody's got to make the paper that's printed. Somebody's got to put the money in there and do it. Think about how many jobs that actually creates for just that one piece of equipment there, right? So there's always opportunity we're not looking at. Yeah.
I think AI, in my opinion, yes, it's going to disrupt some spaces, completely eliminate some other spaces. But I think it's also going to be a complement to what we're doing on a day in, day out basis. Is it going to really disrupt the banking industry? It probably will, alongside with crypto, right? But I think it will also enable us to do a lot greater things, maybe even go international, right? We're no longer going to be lending just nationwide in the US. Maybe we'll be lending global, right? Because of that ability through AI and through, organizations and crypto. So I think that there's a lot of opportunity through AI. I think we just have to be patient. But most importantly, we also have to be cognizant of the fact that we have to stay up to beat, right? We have to know exactly what's happening. We have to keep ourselves educated, keep ourselves learning. I'm on YouTubeuniversity.com every single day. Right? YouTube.com. I'm driving, I'm showering, I'm in the gym, I'm on YouTube, right? Because I want to be able to learn as much as I can. And, hearing some of the really smart guys speak triggers a lot of ideas and thoughts for you as far as, hey, you know what? This is the direction I need to go, and this is what I need to be doing to safeguard, the businesses that we've built so far.
Agreed, man. You and I are kindred spirits here because I live on YouTube. I am on YouTube.
Same.
I'm not just posting my own stuff, but I'm watching so much content. I don't watch TV really at all. I watch learn it.
YouTube TV or YouTube.com. That's it. Love it.
It is the best. Well, Ruben, thank you so much for being a guest here and coming on. I really appreciate it. I'm hoping that we can send a lot of business your way, both for me utilizing myself and my team, and as well as our audience here. Hopefully a lot of people
appreciate it. Thank you so much.
Beautiful.
Thank you. Well, appreciate it, man.
You got it. All right, everybody, we'll catch you on the next episode.
You've been listening to Flipping Out with Paul Lizell, the #1 success platform for virtual wholesalers. Visit our website, thevirtualinvestor.co, for more information about how you can leverage virtual wholesaling to take control of your time, enjoy financial freedom, and live life the way you've always wanted to. Join us again next time for another informative discussion right at your fingertips.